Price crashes. Then suddenly, it starts going up again. It looks like a recovery. It feels like the bottom is in. But then, it drops even harder. This is known as a dead cat bounce, one of the most common traps in financial markets. That's why in this video we're going to understand what a dead cat bounce really is, so we don't get fooled by it. We will also cover why do dead cat bounces happen, why traders get trapped, how to identify one on a chart, and the difference between a dead cat bounce and a real reversal. Because in trading, success doesn't come from predicting the market, it comes from not misreading it. Let's get started. Imagine an investment had just crashed. Then, out of nowhere, it bounces back in a single week. Investors start to wonder, is the worst over? Is this the turnaround? Often it's not. It's what traders call a dead cat bounce. The term comes from the grim idea that even a dead cat will bounce if it falls from a high enough height. In markets, it describes a brief, sharp recovery inside a much larger downtrend, a false signal that tricks people into thinking the selling is done. So, why does a dead cat bounce happen? There are four main forces at work. First, short covering. After a sharp drop, short sellers take profits. To close their positions, they have to buy, creating temporary upward pressure. Second, bargain buyers. The asset looks cheap, so early buyers step in. But they're reacting to price, not real improvement. Third, false hope. Small positive news or momentum attracts attention. More buyers jump in, driven by FOMO. But here's the key. The trend hasn't changed. Fourth, the underlying problem hasn't changed. This is the critical part. A dead cat bounce doesn't happen in a vacuum. It happens inside a downtrend. The reason the asset was falling in the first place is still there. Once the short covering exhausts itself and the bargain hunters realize nothing has improved, selling continues. And the second leg down is often more brutal than the first, because now there are fresh longs who bought at the top of the bounce. So, why do traders get trapped in a dead cat bounce? It comes down to psychology. Markets are made of people, and people have a deep need to believe the worst is over. After a painful decline, any upward movement feels like relief, and that relief gets mistaken for recovery. This is where confirmation bias kicks in. Instead of asking, is this really the bottom? Traders start looking for reasons to believe that it is. And that's what makes a dead cat bounce so dangerous. It feels like relief. It looks like recovery. But in reality, it traps the very people who are trying to call the bottom. A dead cat bounce is not a reversal. So, how do you spot a dead cat bounce? The honest answer is, you often can't, at least not in real time. But there are warning signs. The bounce happens on lower than average volume. Not strong conviction buying, just temporary covering. The fundamental story is still the same. The reason the market dropped hasn't gone away. The bounce is usually limited. It often retraces only a small portion of the drop, around 10 to 20%, before stalling. Professional traders don't just look at price, they watch the character of the bounce. Is there real buying pressure behind it? Or is it just a moment where sellers paused? So, what's the difference between a dead cat bounce and a real reversal? At first glance, they look exactly the same. Price falls, then it starts going up. But what happens next is what separates the two. In a real reversal, you'll see strong buying pressure. Higher highs, higher lows, breaks of key resistance. This is important. A reversal doesn't just move up once. It forms a higher low, and then pushes into a higher high. That's how a new uptrend begins. The market is no longer weak. It's starting to turn. In a dead cat bounce, you won't see that structure. Instead of forming higher lows, the market continues to make lower lows. The bounce fails, and the downtrend resumes. If you find this helpful, please visit investorhubx.com for more lessons just like this. We are building a complete learning platform designed to help investors like you master technical analysis, stocks, cryptocurrency, commodities, precious metals, property investing, and more, step by step. You will also get access to custom indicators and in-depth video courses to support your learning journey and take your skills to the next level. To summarize, a dead cat bounce is one of the market's cruelest tricks, not because it deceives the cynical, but because it deceives the hopeful. Understanding why it happens doesn't make you immune to it, but it might make you pause the next time a crashed asset starts to look tempting. And ask yourself, is this a recovery or just a temporary bounce in a downtrend? If you found this lesson helpful, please give the video a thumbs up, subscribe to the channel, and turn on notifications for future lessons. I'll see you in the next video.